The experts claimed silver would never reach $90. They insisted it was beyond possibility, that financial systems were secure and everything was under control.
Then reality proved otherwise. Silver hit $90, revealing something far more significant than just a price point.
If you're reading this now, it's no coincidence.
This message has reached you because you're entering a new chapter of your life.
How you act from here will determine whether you simply get by in the coming years or truly excel.
Years ago, I found myself in a small room, financially struggling and confused, studying market data late into the night while others were sleeping.
I kept wondering why certain people always stayed ahead while others constantly played catch-up.
Then I understood something straightforward yet profound. The world favors those who prepare, not those who merely hope.
Winners aren't people who forecast the future flawlessly. They re-individuals who take position before the masses realize what's happening.
Silver reaching $90 represents more than just a number. It's an indicator. It signals mounting pressure within the financial infrastructure. It reflects years of poor choices, excessive money printing, and manufactured stability finally confronting truth. When systems experience strain, they don't fail gradually, they fracture suddenly. This is why experienced investors like Peter Schiff have long cautioned that when precious metals finally shift, they shift rapidly. And when they shift rapidly, human emotions become intense. Fear erupts, greed emerges, and wealth quietly changes hands while crowds argue on social media. Here's the first principle you must grasp. Disruption is the price of opportunity. Every significant fortune throughout history was created during periods when most people felt afraid. During the 1970s, while inflation devastated savings, those holding tangible assets grew their wealth substantially. In 2008, while media proclaimed disaster, investors who recognized value silently positioned themselves and emerged wealthier. This pattern continues because human nature remains constant. Your task isn't to forecast every movement. Your task is to become someone who maintains composure when the world loses it. Consider silver as a pressure indicator. When it climbs this quickly, it's signaling that something underneath is breaking. Faith in currency diminishes, debt becomes more burdensome, and tangible assets regain importance. The disciplined investor doesn't follow trends blindly. They establish protection first, then seek opportunities. They diversify not because it's fashionable, but because they acknowledge uncertainty. Here's a practical adjustment. Stop thinking about money. Start thinking about strategic positioning. Where would you stand if inflation intensifies? Where would you stand if markets crash violently? Where would you stand if currencies lose their buying power? Wealth isn't created by responding to events. It's created by being prepared for them. Look at someone like Ray Dalio. His greatest achievements didn't stem from perfect forecasts. They came from creating systems that function across multiple scenarios. He prepared simultaneously for inflation, deflation, expansion, and contraction. That approach alone placed him in an entirely different category of thinking. The second principle, emotional mastery is a financial advantage. When prices surge, people feel unstoppable. When markets decline, they feel hopeless. Both reactions sabotage returns. The investor who succeeds is the one who maintains their process when emotions are overwhelming. That's why you must establish habits now while circumstances still feel ambiguous. Consistent investing, risk control, tangible assets, forward-thinking strategies, these are mundane, and that's precisely why they succeed. Here's your micro-adjustment. Whenever you experience fear, ask yourself, what is this feeling protecting me from? And whenever you experience excitement, ask, what danger am I overlooking? Those two questions alone will prevent years of errors. The third principle, your financial reality reflects your personal reality. If you avoid discomfort in one area, you avoid advancement in the other. Every successful entrepreneur you respect, whether Elon Musk, Jeff Bezos, or the quiet investor who never makes headlines, walked straight into uncertainty when others fled from it. They didn't wait for ideal circumstances. They developed discipline, understanding, and bravery while the world hesitated. This is where transformation begins. Secure before you chase, create emergency funds, eliminate destructive debt, acquire assets that retain worth when currencies deteriorate, invest steadily rather than emotionally, examine macro patterns instead of daily fluctuations, select long-term safety over immediate comfort, and most importantly, transform your self-perception. Stop viewing yourself as someone attempting to survive the economy. Start viewing yourself as someone learning to command it. Because when silver moves like this, it's not warning you to panic, it's inviting you to evolve. Years ahead, you'll recall this period. You'll remember whether you prepared or delayed, whether you studied or distracted yourself, whether you built discipline or followed the masses. Your future self is already observing your choices today. Silver at $90 isn't merely a figure on a screen. It's a communication, an indicator, a pressure warning within the global financial infrastructure that conveys a much deeper narrative than most people want to acknowledge. When a metal that has served as currency for millennia suddenly accelerates upward, It's not purely from speculation. It's because trust in everything else is gradually fracturing. Historical evidence shows that precious metals don't behave this way in stable conditions. They behave this way when hidden tension has been accumulating for years beneath the surface of currencies, debt, and political choices. Every spike echoes decisions made long before the public experiences the effects. And by the time headlines report it, the actual transformation has already commenced. For decades, the world has existed on manufactured comfort, printing currency faster than generating productivity, borrowing future wealth to finance present convenience, guaranteeing stability while quietly undermining the foundation. Silver rising is what occurs when reality starts questioning illusion. It's not about profit graphs or short-term trading excitement. It's about purchasing capability, confidence, and the gradual deterioration of worth that most people only recognize when their savings suddenly purchase less, their earnings stretch thinner, and the future appears more uncertain than before. In those instances, people question why nobody alerted them, but the indicators were always present. In metals, in commodities, and the pattern of long-term capital shifting from paper guarantees to concrete value. Every major financial transition in history displayed these same warnings. During the 1970s, inflation consumed cash and bonds, while gold and silver protected those who grasped what was occurring. In 2008, central banks inundated markets with fresh currency. The lasting impacts of those choices are only now becoming undeniable. Silver touching $90 isn't the occurrence itself. It's the evidence emerging from behind the veil. And intelligent investors don't wait for the blaze to manifest before acting. What makes this moment hazardous isn't the price shift. It's the emotional reaction that accompanies it. When metals climb rapidly, fear and greed clash. Markets become volatile. People make choices based on headlines rather than reasoning. And that's when wealth moves from the hasty to the controlled. The violence isn't physical, it's mental. It's the jolt that arrives when expectations shatter and people recognize the system they relied upon is far less secure than they thought. Those who thrive during these periods aren't prophets. They're resilience builders. They position themselves across tangible assets, enduring value and cautious risk oversight. While the majority awaits reassurance that never arrives, they comprehend that silver's climb isn't something to pursue. It's something to respect. A sign that the world is changing direction, and that survival and achievement now require preparation, understanding, and emotional control rather than comfort and routine. If this message sharpened your perspective even slightly, you're on the correct trajectory. Support this channel by engaging with the content and sharing it with someone who needs this awareness. The turbulence isn't the conclusion of the narrative. For the prepared, it's the opening. Many believe wealth originates from forecasting the future, but history quietly demonstrates otherwise, that enduring achievement is constructed by those who prepare for numerous futures rather than attempting to predict just one. Preparation isn't thrilling.
It doesn't generate headlines, and it seldom feels pressing during comfortable periods. Which is exactly why it becomes invaluable when conditions transform. Those who prepare early seem fortunate later. But fortune is simply the observable aspect of discipline that others didn't witness while it was being constructed.
Prediction depends on information that's always incomplete, always delayed, and always influenced by emotion. Preparation depends on principles that remain constant regardless of situations. The investor who prepares creates buffers, spreads risk, studies patterns, and trains their mindset long before volatility emerges. They recognize that markets don't progress in direct lines, economies don't expand indefinitely, and no system is resistant to strain. Rather than gambling everything on a single result, they structure their existence so that multiple results can still generate advancement. Examine the most consistent wealth creators across generations. They didn't rely on perfect timing, they relied on solid frameworks. They maintained tangible assets, managed expenses, preserved liquidity, and safeguarded their downside before pursuing upside. When recessions emerged, they didn't freeze because their preparation had already eliminated panic from the situation. While others were compelled to sell at the least favorable moment, the prepared quietly accumulated, understanding that cycles always reward patience over emotion. In personal existence, the same principle operates. Those who develop their abilities before opportunity appears are the ones who advance with assurance. Those who accumulate before crisis arrives are the ones who rest peacefully while others struggle. Those who fortify their mindset before hardship strikes are the ones who guide when everyone else is confused. Preparation is the invisible labor that generates visible strength. The hazard of depending on prediction is that it feeds pride. It makes people think they're more intelligent than the system, quicker than the market, exempt from errors. Preparation humbles you. It compels you to acknowledge uncertainty, honor risk, and function with caution even when everything appears tranquil. It creates a quiet form of confidence that doesn't crumble when plans shift. Every major achievement narrative contains years of unglamorous groundwork. Businesses that endured downturns invested in resilience long before revenue declined. Investors who prospered during chaos had already decreased their vulnerability to fragile assets. Families that remained steady during financial turmoil created safety margins long before the storm clouds materialized. Preparation isn't pessimism, it's strategic optimism. It's the conviction that your future deserves protection even when the present feels comfortable. It's selecting structure over impulse, discipline over desire, patience over prediction, and constructing an existence that doesn't depend on the world behaving exactly as anticipated. Disruption is the admission cost of opportunity. Nobody avoids paying it if they want to advance beyond the average. Every meaningful evolution, whether in markets, business, or personal existence, starts with disorder. Comfort maintains the present, but chaos generates the future. When systems become unstable, when routines break down, when familiar frameworks no longer feel dependable, that's not the termination of advancement. It's the start of a higher tier of it for those who understand how to navigate the turbulence. History contains numerous examples of people who entered chaos and emerged more powerful, while others waited for security that never returned. During the Great Depression, while fear dominated the majority, entrepreneurs like Walt Disney and investors who understood lasting value quietly constructed foundations that would influence the following century. Following financial collapses, new industries emerge, new leaders ascend, and new wealth forms. Not because the chaos is enjoyable, but because it compels innovation, clarity, and bravery. Most people resist chaos because it threatens identity. It eliminates the labels, the routines, the illusions of command that make existence feel predictable. But when those layers disappear, what remains is pure capability. The person who learns to exist within uncertainty without collapsing gains an uncommon advantage. They perceive opportunities where others perceive danger. They act while others freeze. They develop while others lament what was lost. In investing, chaos exposes authentic value. Prices disconnect from fundamentals. Emotions overwhelm logic. And markets present assets at levels that seem unreasonable to those blinded by fear. The disciplined investor comprehends that volatility isn't an adversary. It's the environment where long-term advantage emerges. They don't celebrate chaos, but they honor it, understanding it's the passage through which the future enters the present. In personal development, chaos compels evolution. When existence disrupts plans, it's requiring expansion. Previous strategies cease functioning, old habits lose their effectiveness, and fresh thinking becomes essential. Those who grasp the past suffer most. Those who adjust construct new versions of themselves that are stronger, more insightful, and more capable than before. The expense of opportunity is discomfort. The payment is uncertainty. The benefit is transformation. Every accomplished person carries narratives of seasons where nothing felt stable, nothing felt secure, and everything felt threatened. Those seasons didn't destroy them. They prepared them. They acquired resilience by navigating through instability. They acquired discipline by functioning without guarantees. They acquired leadership by accepting responsibility when no clear solutions existed. Chaos removes illusion and exposes truth. It demonstrates who is prepared and who is pretending. It discloses whether your foundation is constructed on comfort or on character. Those who accept chaos as part of the journey cease fearing it. They begin utilizing it. They recognize that while others are seeking shelter, the designers of the future are already constructing inside the turbulence. Emotional discipline is the investor's greatest advantage because markets don't defeat people. People defeat themselves. The majority of financial losses don't originate from lack of intelligence or information. They originate from fear, greed, impatience, and the incapacity to remain composed when uncertainty surfaces. Charts, data, and strategies only function for those who can execute them when emotions are intense. Without emotional control, even the finest plan becomes worthless at the most critical moment. When prices climb, confidence transforms into overconfidence. People feel invulnerable, persuaded that momentum will never conclude, that this occasion is different, that they've finally decoded the pattern. They discard caution, pursue hype, escalate risk, and disregard warning indicators. When prices drop, the reverse occurs. Fear dominates, logic vanishes, and the same people sell at the lowest point to escape suffering. The cycle continues because human psychology seldom changes, and the investor who conquers that psychology obtains an advantage that no algorithm can duplicate. Consider Warren Buffett's career. His greatest gains weren't generated by brilliant forecasts, but by emotional restraint. He waited patiently when the crowd was euphoric and acted decisively when the crowd was terrified. During the financial crisis, while panic distributed across global markets, he invested billions into companies that others were desperate to desert. His advantage wasn't superior forecasting, it was superior self-governance. In personal existence, the same principle operates. The capacity to maintain composure under pressure distinguishes leaders from followers. When problems surface, emotionally disciplined people decelerate, think clearly, and respond with purpose. Emotionally reactive people hurry, blame, and undermine their own advancement. The quality of your choices under strain determines the quality of your outcomes over time. Constructing emotional discipline is a daily exercise, not a personality characteristic. It begins with awareness. You monitor your reactions without allowing them to govern your actions. You learn to pause before choosing, to distinguish short-term feelings from long-term objectives. You establish systems that shield you from your own impulses, such as predetermined investment principles, automated savings, and documented plans that direct your behavior when emotions attempt to dominate. Every accomplished investor has acquired this lesson through difficulty. They've experienced the surge of greed and the burden of fear. The distinction is they train themselves to act regardless. They comprehended that comfort isn't an indicator of correctness, and discomfort isn't an indicator of danger. Frequently, the correct choice feels uncomfortable because it opposes the crowd, and the incorrect choice feels comforting because everyone else is executing it. Emotional discipline doesn't eliminate uncertainty, but it transforms your relationship with it. Rather than being governed by the market's temperament, you become the one governing your response. And in that interval between stimulus and action, long-term wealth is quietly constructed. Positioning matters more than timing because the future seldom arrives on schedule, and those who wait for perfect moments typically watch opportunity pass them by. Timing relies on precision, prediction, and fortune, while positioning relies on preparation, structure, and patience. The person who is appropriately positioned doesn't need to capture the exact bottom or peak of a market because their foundation enables them to profit from long-term movement regardless of short-term fluctuation. Most people spend their existence waiting for signals that feel safe. They wait for confirmation, for stability, for certainty, for authorization. But by the time all of those manifest, the largest portion of the opportunity is already gone. The market compensates those who commit while uncertainty still exists, not those who respond once the route is evident. Positioning means placing yourself where advancement can reach you, even if the path is uncomfortable. In business, the most accomplished companies didn't wait for perfect conditions. Amazon expanded aggressively during the dot-com collapse when competitors were withdrawing. Apple reinvented itself during periods of financial pressure and declining confidence. They positioned themselves for the subsequent era before the subsequent era arrived. Their leadership comprehended that survival and dominance originate from strategic placement, not perfect timing. In personal finance, positioning is about constructing assets, abilities, and systems that compound over time. It means possessing productive resources, developing knowledge, and maintaining adaptability. It means decreasing dependency on fragile income sources and increasing involvement in growth. Someone who is positioned effectively can withstand volatility because their foundation absorbs impact and continues to generate advancement. Timing is fragile because it assumes command over occurrences that are uncontrollable. Markets shift based on countless variables beyond any individual's influence. Positioning accepts this reality and concentrates on what can be controlled. You can control your habits, your education, your savings proportion, your risk involvement, and your long-term vision. These elements determine whether opportunity becomes accessible when it manifests. Positioning also applies to mindset. The person who perceives change as a threat will always hesitate. The person who perceives change as a gateway will always act. When new industries emerge, new technologies develop, or economic conditions shift, those who are mentally positioned for growth adjust quickly while others grasp the past. Every major breakthrough in existence comes to those already standing in the correct location when the entrance opens. They may not know precisely when it will occur, but they've prepared for it. They've constructed themselves into the type of person who can advance with confidence when opportunity arrives. That's why positioning outperforms timing, because it transforms uncertainty into advantage and converts waiting into forward momentum. Tangible assets protect when paper guarantees fail because value isn't generated by ink and signatures. It's generated by substance, usefulness, and confidence that survives beyond systems and policies. Throughout history, whenever currencies deteriorate, debts multiply, or governments overreach, paper wealth diminishes while concrete value persists. This isn't ideology, it's pattern. Gold, silver, land, productive businesses, and essential resources have outlasted every monetary experiment ever conducted. Paper systems rely on confidence. When that confidence is robust, everything feels stable. When that confidence deteriorates, everything changes rapidly. Inflation, currency degradation, and debt crises don't announce themselves courteously. They creep in, then accelerate, then suddenly become undeniable. In those moments, people discover the distinction between possessing something and merely being guaranteed something. During periods of economic strain, history demonstrates the same behavior repeating. In Weimar Germany, Zimbabwe, Argentina, and numerous other instances, paper currency collapsed while those maintaining tangible goods preserved buying power. Even in modern financial crises, stocks of companies with genuine products, land that generates value, and precious metals that cannot be printed remain anchors of stability when paper claims struggle to maintain pace with reality. Possessing tangible assets isn't about fear, it's about accountability. It's the recognition that no institution, no government, and no system is eternal. Structures develop, policies transform, leaders change, but physical value remains. A productive farm nourishes regardless of currency. A functional business generates regardless of politics. An ounce of silver maintains intrinsic worth regardless of headlines. This principle also applies to your personal development. Abilities, health, reputation, and knowledge are tangible assets. They cannot be inflated away. They cannot be seized by market crashes. They compound quietly over time and provide leverage in every environment. And the more of these assets you construct, the less dependent you become on fragile systems beyond your command. Wealth constructed entirely on paper is vulnerable to decisions you never supported and policies you cannot influence. Wealth anchored in tangible assets is grounded in the concrete world of production, usefulness, and demand. That's why disciplined investors allocate part of their capital to things that cannot be eliminated by policy shifts or accounting modifications. Tangible assets don't guarantee perfection, but they provide resilience, they stabilize portfolios, protect buying power, and offer tranquility when uncertainty rises. They remind you that value is not what someone declares it to be, but what remains useful, scarce, and desired regardless of circumstance. In an era of digital figures and abstract claims, the investor who honors tangible value constructs a foundation that survives cycles, storms, and systems that eventually disappear. Your financial existence mirrors your personal discipline more closely than most people are willing to acknowledge. Currency doesn't simply respond to market conditions, it responds to habits, choices, consistency, and self-governance. The manner you manage small responsibilities is the manner you'll manage large ones. The manner you treat time is the manner you'll eventually treat wealth. Discipline isn't something you activate once you become accomplished. It's the foundation that makes achievement possible initially. People frequently seek external explanations when their finances feel unmanageable. They blame the economy, their employment, the market, their circumstances, but beneath all of that lies daily behavior. Spending patterns, saving habits, learning routines, and emotional reactions to pressure gradually construct financial outcomes, whether consciously or unconsciously. When discipline is weak, currency leaks through 1,000 invisible openings. When discipline is robust, even modest income becomes powerful over time. Consider how elite athletes train. Their performance on competition day reflects months and years of preparation, not just talent. They wake when they don't feel inclined, train when nobody is observing, execute routines that appear mundane to outsiders. Wealth creation follows the same principle. It's constructed through repeated actions that are seldom glamorous. Budgeting, investing consistently, learning continuously, controlling impulses, delaying gratification. The person who cannot manage personal habits will struggle to manage financial ones. Skipping workouts becomes skipping research. Procrastinating on objectives becomes procrastinating on investments. Avoiding discomfort becomes avoiding opportunity. Conversely, when discipline strengthens in one area of existence, it extends to all others. A person who constructs structure in their mornings frequently constructs structure in their finances. A person who commits to development in their mind frequently commits to development in their wealth. Every accomplished entrepreneur and investor comprehends this connection. They don't separate personal development from financial development. They improve both simultaneously. They construct routines that support clarity, energy, focus, and decision-making. They safeguard their attention from distractions that deplete productivity. They treat their objectives as commitments, not wishes. Discipline also constructs confidence in yourself. When you fulfill commitments to your own development, confidence becomes stable. You cease needing motivation because momentum propels you forward. This internal reliability becomes observable in your financial existence as consistent advancement, controlled risk, and long-term stability. Your bank account isn't merely a figure, it's feedback. It reflects how effectively you manage your energy, your emotions, your time, and your priorities. When you strengthen your discipline, your finances respond automatically. Transform the manner you live, and your currency will eventually follow the same pattern.